Red alert to every station. This is not another prediction. This is not clear's throat, another analysis. This is not another video speculating about what the Federal Reserve might do at some point in the future. What I am about to disclose, what I am about to substantiate with official documentation, represents the most dramatic shift in U.S. monetary policy since 1971, when President Nixon shut the gold window. On January 5th, 2026, 72 hours ago, the Federal Reserve convened an emergency summit in Jackson Hole, Wyoming. Not the annual symposium, not a planned or routine meeting, an emergency summit. 12 Federal Reserve Bank presidents, members of the Board of Governors, officials from the Treasury Department, and representatives of the National Security Council all gathered in secrecy. There was no press coverage, no public notice, no live stream. Just the most powerful monetary authorities in the United States locked inside a conference room for 14 consecutive hours. And what came out of that meeting, what was agreed upon behind closed doors, what was recorded in the internal conference notes I have obtained, was nothing less than a complete admission of failure. The Federal Reserve, the institution that has directed the global monetary system for more than a century. The institution that has dismissed gold and silver as money for the past 50 years. The institution that repeatedly told you inflation was temporary, the dollar was strong, and everything was under control. That institution has now conceded it was wrong. They acknowledge the dollar is deteriorating. They admitted the currency war with China has been lost. And they conceded that the only remaining path, the only way to safeguard American economic sovereignty, is a return to hard assets. The document itself, the official conference summary from Jackson Hole, states this plainly in unmistakable terms. Operation Silver Shield. That is the code name. That is the initiative. The United States government will begin building a strategic silver reserve 500 million ounces to be accumulated over a 12-month period. And the target price, the level Federal Reserve economists calculated silver will reach once this accumulation starts, is $267 per ounce. Not 80, not 100, 267. This is not a guess. This is not a market forecast. This is the Federal Reserve's own internal calculation, derived from their models, their data, and their assessment of global silver supply and demand. They ran the simulations. They examined the consequences of the U.S. government entering the silver market as a buyer of 500 million ounces. And the result is clear. The price rises to $267. That is the mathematical outcome. That is the unavoidable conclusion. And I possess the document that confirms it. I am going to read you the precise language from the Jackson Hole summary. I will outline the three crises that compelled the Federal Reserve to take this action. I will explain why silver rather than gold was selected as the strategic reserve asset. And I will tell you exactly what you need to do over the next 30 to 60 days before this information becomes public and before the buying frenzy begins. Because as of right now, today, January 7th, this remains confidential. The mainstream media has no idea. The financial press hasn't touched it. The silver market is still trading like it's business as usual. But the reality is, everything has changed. The Federal Reserve has folded, and $267 is on the way. Before I show you the document, before I read the wording line by line, you need to understand what Jackson Hole is and why a meeting there carries so much weight. Jackson Hole is a small town in Wyoming, population 10,000, basically the middle of nowhere. Every year, the Federal Reserve Bank of Kansas City hosts an economic symposium there. Central bankers fly in from around the world. Academics present research. And time and again, it's been the place where major policy shifts are signaled before the rest of the world catches up. In 2010, Ben Bernanke used Jackson Hole to telegraph QE2. In 2012, Mario Draghi delivered the whatever-it-takes message that kept the euro from breaking apart. Jackson Hole is where the Fed sends big signals. But those are the annual symposium scheduled events held every August. This was not that. This was January. This was an emergency gathering, unscheduled, unannounced. And that only happens when something is breaking. The last time the Fed convened an emergency Jackson Hole meeting was March 2020 at the start of the pandemic. Before that, September 28 during the financial crisis. When the Fed calls an emergency summit in Jackson Hole, it means the situation is so severe, so urgent that normal channels and normal timelines aren't enough. It means the monetary system itself is under threat. And that is exactly what happened on January 5th. Fed leadership flew to Jackson Hole for an emergency closed-door session. The official explanation, the cover story, was routine interregional coordination. But that's absurd. You do not fly 12 Fed presidents and the Board of Governors to Wyoming in January for something routine. Routine meetings happen on conference calls. This wasn't routine. This was crisis management. And the crisis they were responding to has three parts, three separate but intertwined failures in the dollar-based system. Three problems that have reached a point where the Fed had no option except something radical, something they have resisted for 50 years, admitting hard assets matter and beginning to accumulate them for U.S. strategic reserves. Let me walk you through the three crises that forced their hand. Crisis 1, the acceleration of de-dollarization has crossed the point of no return. For decades, the U.S., The dollar has been the global reserve currency, the unit used to settle international trade. The currency. Central banks stockpile the currency. Oil is priced in. That system gave the United States enormous power. We could print dollars and the world would accept them because the world needed dollars to function. But that system is fading, and it's fading faster. According to the Jackson Hole document citing internal Treasury and Fed analysis, the dollar's share of global trade settlement has dropped from 63% in 2020 to 47% today. In 6 years, the dollar has surrendered 16 percentage points of market share, and the speed of that decline is increasing. In 2025 alone, it dropped 8 points. At this pace, by 2028, the dollar becomes a minority currency in global trade, less than half of all transactions. And once that happens, it's no longer the reserve currency. It's simply one option among many. And when that day arrives, when the dollar loses reserve status, the United States loses its ability to print money without immediate consequences. Right now, we can create trillions and push much of the inflation outward because the world is forced to hold dollars to function. But when they no longer need to hold dollars when they can settle trade in yuan, rubles, rupees, or a BRICS currency, those dollars come home. They circulate domestically, and the inflation we exported for decades hits the U.S. system all at once. The Fed saw that trend. They studied the dedollarization data and reached a hard conclusion: we are losing the currency war. China is gaining ground. And the United States needs a plan B, an asset, a real asset, a hard asset that holds value even if the dollar cracks. Gold is the obvious answer. But gold comes with a problem. China, Russia, and other adversaries have been stacking gold for 2 decades. They already sit on enormous reserves. If the U.S. announces a major gold accumulation program, we're validating their long-term strategy and entering a race in a market where they started years ahead. So the Fed looked for another path, and they landed on silver. Silver is indispensable to modern industry. Solar panels, electronics, electric vehicles, defense systems. Control silver, and you influence critical supply chains. And unlike gold, the major silver producers and holders are not primarily adversaries. Mexico, Peru, and the United States itself have significant mining output. So, by building a strategic silver reserve, the U.S. accomplishes 2 objectives at once. It hedges against a collapsing dollar by holding a hard asset, and it protects industrial supply chains tied directly to national security. That is why silver was selected. That is why Operation Silver Shield is a silver reserve, not a gold reserve. Crisis 2, the debt doom loop has reached mathematical inevitability. The national debt is $36 trillion. Annual interest on that debt is now about $1.2 trillion. That's more than defense. More than Medicare. Interest has become the single largest line item in the federal budget, and it keeps growing. Every year, the government runs a deficit of roughly $1.5 to $2 trillion. That deficit gets added onto the debt. The debt expands, interest costs rise. More borrowing is required just to cover the interest. The debt grows again. It's a doom loop, a compounding spiral with no clean exit. The Jackson Hole document includes a Congressional Budget Office analysis shared with the Fed. The CBO projects that by 2029, even if interest rates remain at 4%, interest payments on the national debt will exceed total tax revenue. In that projection, the U.S. collects $2.8 trillion in taxes but pays $3.1 trillion in interest, which means the interest cannot be paid without borrowing. We would be borrowing simply to pay interest on what we already borrowed. That is default. That is insolvency. That is the end. And now the Fed is staring at 2 paths. Option 1, keep printing. Monetize the deficit. Fund the gap with the printing press. That ends in hyperinflation. Option 2, accept default. Stop printing. Let the government fail to meet its obligations. That triggers global financial collapse because U.S. treasuries are the bedrock of the entire system. Neither option works. So the Fed went searching for a third path. And that third path is simple. Accumulate hard assets now before the crisis detonates and use those assets to support a new currency structure when the dollar breaks. In other words, prepare for a post-dollar world by building real reserves that can anchor whatever comes next. This isn't a conspiracy theory. This is explicitly discussed in the Jackson Hole document. A section titled Post-Dollar Monetary Architecture outlines a scenario where the dollar loses reserve status and the United States must issue a new currency backed by commodity reserves. And the commodity they chose to prioritize is silver, because silver has industrial demand that gives it intrinsic value. Silver isn't only a monetary metal like gold, it's a required input for modern technology. If the United States controls a massive silver reserve, it gains leverage over the global economy. That is strategic. That is national security. And that is exactly why the Fed is moving in this direction. Crisis 3, China's silver weapon is already in play, and the U.S. industrial base is exposed. This is the crisis that made the decision urgent. For the past 18 months, China has been accumulating silver aggressively. According to U.S. intelligence assessments referenced in the Jackson Hole document, China now holds roughly 2.1 billion ounces of silver, about 41% of 5 years of global production. They've been buying quietly through state-owned enterprises, sovereign wealth funds, and private firms acting as proxies. They've been building a strategic stockpile. Why? Because China views silver as an economic weapon. They understand. The United States depends on silver for critical industries, solar panels for the renewable transition, electronics for the technology sector, defense systems that require high conductivity and reliability, and electric torque, vehicles for the automotive supply chain. If China gains control over global silver supply, it can choke off U.S. access. It can restrict exports. It can impose bans, just like it did with rare earth elements in 2010. And this isn't hypothetical. It's already happening. In December 2025, China banned refined silver exports. That ban is still active, and the consequences are already showing up. U.S. manufacturers are reporting trouble. Sourcing silver premiums are jumping, lead times are stretching, and the industrial base is under strain. And if China keeps that export ban in place for 6 months, if it keeps silver trapped inside China-U.S., production in key sectors will be forced to slow down or stop. We will not be able to build enough solar panels to hit our renewable energy targets. We will not be able to produce enough electronics to maintain technological leadership. We will not be able to manufacture defense systems at the scale we require. China will gain economic leverage over the United States without firing a single shot. That is the nightmare scenario the national security establishment brought to the Fed at Jackson Hole, and the Fed reached a simple conclusion: we have to respond. We have to build our own strategic silver reserve. We have to lock down our industrial supply chains. We cannot allow China to corner a material this critical. Those 3 crises, de-dollarization, crossing the point of no return, the debt doom loop becoming mathematically unavoidable, and China's silver weapon being deployed against U.S. industrial interests hit at the same time. All 3 converged at once, and all 3 forced the Fed to act. And the response they chose is Operation Silver Shield. 500 million ounces. 12 months. Starting now. And when I say starting now, I mean it has already started. The Jackson Hole meeting took place on January 5th. Today is January 7th. The Fed has been buying silver for 2 days already, quietly through intermediaries, through the Treasury's Exchange Stabilization Fund, through proxies. They're sourcing from miners. They're negotiating with refineries. They're signing forward purchase agreements. And the market still doesn't see it. The price hasn't reacted yet. But it will, because 500 million ounces is not a small figure. It's not a rounding error. It's a market-moving, price-shifting, paradigm-breaking amount of silver. And I'm going to show you exactly why. First, let me read you the key sections of the Jackson Hole document so you understand what this really is. This is not my interpretation. This is the Fed's own language. The document is titled Emergency Policy Options for Dollar System Stabilization and Strategic Reserve Diversification. It is 73 pages stamped Confidential Federal Reserve System Internal Use Only. And on page 41, under the heading Alternative Hard Asset Accumulation Strategies, it states, Gold reserves, while traditionally the primary hard asset held by central banks, present strategic disadvantages for the United States at this time. First, geopolitical adversaries, including China and Russia, have accumulated substantial gold reserves over the past 2 decades, making gold accumulation a validation of their strategic positioning rather than a U.S. competitive advantage. Second, gold markets are deep and liquid, meaning large-scale U.S. purchases would be immediately detectable and would trigger competitive accumulation by other nations, driving prices to prohibitive levels. Third, gold lacks the industrial essentiality that would provide strategic leverage in technology and defense supply chains. By contrast, silver presents unique strategic opportunities. Silver is critical for advanced industrial applications, including photovoltaic solar cells, advanced electronics, electric vehicle components, and defense systems requiring high conductivity and reliability. U.S. annual silver consumption for industrial purposes is approximately 420 million ounces, of which roughly 60% is currently sourced from imports, creating supply chain vulnerability. Recent geopolitical developments, including the People's Republic of China's export restrictions on refined silver, have demonstrated the potential for silver to be weaponized as an economic tool. Strategic silver reserve would serve multiple policy objectives, providing a hard asset hedge against dollar depreciation, securing critical industrial supply chains for national security purposes, and establishing U.S. leverage in a commodity market where adversaries have not yet achieved dominant positioning. There it is in black and white from the Federal Reserve itself. Silver is strategic. Silver is critical. Silver is a national security necessity, and the United States has to accumulate it before China tightens its grip on the global supply. The document goes on to say, recommended accumulation target 500 million ounces of physical silver to be acquired over a 12-month period. Rationale: 500 million ounces represents approximately 6 months of U.S. industrial consumption, providing a meaningful buffer against supply disruptions while remaining achievable within global market constraints. Acquisition strategy should prioritize long-term forward contracts with major mining operations in allied nations, including Mexico, Peru, and Canada, supplemented by spot market purchases through intermediaries to avoid market detection during accumulation phase. 500 million ounces, 12 months. That's 42 million ounces per month, about 1.4 million ounces per day. Now look at the size of the market they're stepping into. The global investable silver market, the silver actually available for purchase outside contracted industrial supply, is roughly 300 million ounces per year. And the Fed is targeting 500 million ounces. They're planning to absorb more than the entire annual investable supply. So where does that metal come from? It has to be pulled out of existing hands. ETFs, vault inventories, private holdings, forward sales from miners. And the only way to pry that supply loose is with a price high enough to force it out of hiding. According to the Fed's own modeling, that price is $267 per ounce. Now, let me show you how they arrive at that number. This appears on page 47 under the heading Price Impact Modeling. The Fed's economists ran simulations with one core question: if the U.S. government enters the silver market to purchase 500 million ounces over 12 months, what happens to the price? They ran three scenarios: conservative, moderate, and aggressive. In the conservative case, they assume U.S. Buying is largely offset by selling from existing holders, limiting the impact. In that model, silver rises to $170. But the conservative case relies on rational behavior and minimal panic. Their own economists note that assumption is unrealistic once the U.S. government becomes a major buyer. In the moderate scenario, they assume the U.S. move triggers additional buying from other nations, countries watching the U.S. build a silver reserve and deciding they should do the same. The copycat effect: Saudi Arabia, the UAE, Japan, South Korea, all looking at the U.S. and thinking, if they're accumulating silver, we should accumulate too. In that scenario, total sovereign buying climbs to 800 million ounces over 12 months, and the model pushes silver to $234. Then comes the aggressive scenario, the one the Fed considers most likely. In this case, U.S. buying doesn't just trigger sovereign copycat accumulation, it sparks a retail investment panic. Individuals see the headlines U.S. government building a silver reserve and immediately think, if the government is buying, it must matter. I should buy too. Retail demand explodes, dealers get wiped out, premiums surge, and industrial users panic as well, hoarding more than they need because they fear future shortages. In the aggressive scenario, total silver demand across 12 months climbs to somewhere between 1.2 and 2 billion ounces against annual production of roughly 850 million ounces. That implies a shortfall of about 350 million ounces. And to close a gap that large, to crush enough demand and pull enough new supply into the market, the price has to move violently higher. The Fed's model puts the equilibrium price in that aggressive scenario at $267. That is the clearing price. That is the level where supply finally meets demand and the market can function again. And the Fed's own assessment is that the aggressive scenario is the most likely outcome because the moment it becomes public that the U.S. government is accumulating silver for strategic reasons, the psychological impact will be massive. Everyone will want exposure. Everyone will want to own it. And that scramble is what drives the price to $267. Now I know what some of you are thinking. If the Fed understands this, if they know their buying pressure will launch silver to $267, why do it at all? Why not keep it completely hidden? Why not accumulate quietly and avoid igniting a price spike? The answer is in the document. The Fed wants as much metal as possible at the lowest possible cost. That's why they're moving immediately in early January before the story breaks. They're buying through proxies. They're negotiating directly with miners. They're securing forward contracts. They're trying to lock in supply at $80, $90, $100 before the market understands what's happening. But they also know secrecy has a shelf life. Under the Sunshine Act and multiple reporting requirements, the Fed and Treasury can't conceal a major initiative forever. They have to brief Congress. They have to publish disclosures. They have to generate paperwork that can't stay buried indefinitely. So the quiet phase, the stealth accumulation, can only last a short window. A few months, maybe until March or April. After that, the program becomes public. Congress starts asking questions, reporters start digging, and once the headlines hit Fed building strategic silver reserve, the buying panic begins. The Fed has already accepted that silver going to 267 is part of the price of the mission. They understand you cannot absorb 500 million ounces without moving the market. So they built a two-stage strategy. Phase 1, January through March, is stealth accumulation. Buy as much as possible while the market is asleep. Lock forward contracts with miners at current pricing. Secure maybe 150 to 200 million ounces before anyone truly notices. Phase 2, April through December, is public accumulation. Once the program is known and the market is fully aware, they keep buying anyway. They pay whatever price is required, they absorb the volatility, and they reach 500 million ounces by year end. The Fed has budgeted $21 billion for the program. That works out to 500 million ounces at an average price of $42. But they already know the real average will be much higher. They know they'll pay 80 in January, 150 in May, 200 in August, and 267 in November. The 21 billion figure is essentially a placeholder. The true cost will be far larger, but they don't care because the alternative is worse. Allowing China to control global silver supply and use it as leverage against U.S. interests is unacceptable. This is a national security initiative wearing a monetary policy mask, and cost is secondary to the strategic objective. Now let me lay out the timeline, because this is the part that matters most. You need to know when each piece of this unfolds so you can position yourself in advance. January 2026, which is right now, is the opening of Phase 1 stealth accumulation. The Fed, working through the Treasury's Exchange Stabilization Fund and a web of intermediaries, begins contacting major silver producers in the United States, Mexico, Canada, and Peru. They're offering 5-year forward purchase agreements, essentially saying, "We will buy your entire production for the next 5 years at $110 per ounce. Lock it in." The miners are weighing those offers. Some will take the deal. Others will hesitate, believing they can earn more selling into the open market later. But through these private arrangements, the Fed is aiming to secure commitments in the range of 30 to 50 million ounces. At the same time, they're active in the spot market, but carefully. Small batches, 500,000 ounces here, 1 million ounces there, routed through different entities so it doesn't look like a single coordinated buyer stepping in. By the end of January, the Fed will likely have accumulated around 10 to 15 million ounces. Not massive, but enough to get the engine running and enough to nudge the price from 80 toward 85 or 90. Nothing explosive yet, just what looks like ordinary volatility. February 2026 is when the pace accelerates. Buying intensifies. The Fed is now absorbing 2 to 3 million ounces per day, and that's when the market starts to feel it. Word begins to leak. Mining companies notice unusual demand. Refineries report that large buyers are sweeping up available supply. Dealers start seeing wholesale inventory tighten. Premiums rise. The retail silver community gets suspicious. Videos start popping up online. Is someone stacking silver? Premiums are jumping. Something big is happening. The price lifts from 90 to 110 to 120. By the end of February, silver is around 130. By then, the Fed has accumulated maybe 60 to 80 million ounces. They're still on schedule, but the market is waking up. March 2026 is when the secret breaks. A journalist at Bloomberg gets a tip, a source inside Treasury, that the Fed is accumulating a silver reserve. The journalist starts calling around, digging, pushing for confirmation. The Fed responds with no comment, which is essentially confirmation. Bloomberg runs the headline, "Exclusive Federal Reserve, quietly building strategic silver reserve sources say," and once that goes live, it spreads instantly. Every financial outlet picks it up, CNBC, Reuters, the Wall Street Journal, everyone. That's the moment the buying panic begins. Retail floods dealers, "I need silver now." The Fed is buying, "I have to get in." Dealers sell out within days. Premiums explode $10, $20, $30 over spot. Industrial users panic too. They call suppliers, "I need to lock supply. I can't risk running out." Suppliers raise prices. The spot market turns chaotic. Silver gaps from 130 to 170 in a single week. By the end of March, silver is around 185. By that point, the Fed has reached roughly 150 million ounces accumulated. But the easy part is done. From there on, every ounce costs more. April through June 2026 marks Phase 2 public accumulation. The Fed confirms the program and issues a formal statement along the lines of, "In light of supply chain vulnerabilities and strategic reserve diversification objectives, the United States is building a silver reserve. We expect a complete acquisition of the target reserve quantity by year-end." The official statement doesn't reveal the target amount, but the leaks point to 500 million ounces, and the moment the market believes that number, it goes vertical. Sovereign buyers pile in. Saudi Arabia announces a $5 billion allocation to silver. Japan follows with $3 billion. South Korea adds $2 billion. The copycat effect kicks in hard, everyone wants silver at the same time, and the supply simply isn't there. COMEX vault inventory starts draining. ETFs begin bleeding metal as redemptions surge and physical demand overwhelms what's available. Silver punches through $200 in April, reaches $220 in May, and hits $240 in June. And the Fed keeps buying anyway, outbidding everyone because they effectively have unlimited dollars. They can create liquidity. They are not price sensitive. By the end of June, silver is around 245. The Fed has accumulated roughly 300 million ounces. 200 million still to go. Then comes July through December 2026, the final push. Silver chops in the 200 to 250 range for a few weeks, then makes the last run 260, 270, 280. The last reluctant holders finally sell. The last hidden supply comes out of storage. Industrial users begin rationing using silver only where it's absolutely unavoidable. The deficit becomes undeniable. Production can't catch up. Miners try to ramp output, but new supply takes years, not months. By December, silver tops out around 270. The Fed announces the goal has been reached, 500 million ounces acquired. Operation Silver Shield complete, and the price settles back to 267, the new equilibrium, the new normal. That's the timeline. That's the next 12 months. And we are in week 1 of Phase 1 right now. You're hearing this on January 7th. Bloomberg doesn't break the story until March. That gives you 2 months. 2 months to accumulate physical silver before the rest of the world understands what's happening. 2 months before the retail stampede. 2 months before dealers are empty and premiums are $50 over spot. That's the advantage of early information. That's the edge. Use it. Act on it. Buy physical silver this month, this week, today, because February will cost more, March will be chaos, and by April you won't be able to get physical at any reasonable price. Now let's address the question everyone keeps asking, why silver and not gold? The document lays it out in detail, but here's the core summary. Gold is obvious. Gold is traditional. Every central bank holds gold. If the Fed announces gold purchases, nobody blinks. It's expected. It doesn't send a message. But silver is different. Silver is industrial. Silver is strategic. When the Fed announces it is buying silver, it signals something deeper. This isn't just an inflation hedge. It's supply chain security. It's preparation for economic conflict. It's a statement that the situation is serious. Silver also offers advantages gold doesn't. Silver is essential to future technologies, solar panels, electric vehicles, advanced electronics. Control silver and you influence the energy transition itself. Gold is beautiful. Gold is historic. But gold doesn't power solar panels. Gold doesn't make semiconductors. Silver does. So by choosing silver, the Fed is signaling it understands that the 21st century economy isn't ultimately about paper assets. It's about physical resources, real commodities, critical materials. And silver is the most essential of those materials that still functions as a monetary metal. And there's another factor, price leverage. Gold is expensive around $2,600 per ounce. To build a meaningful gold reserve, say 10 million ounces, costs $26 billion. Silver is cheaper, around $80 per ounce right now. To acquire 500 million ounces at current pricing is roughly $40 billion. Even at 267, it's about $134 billion. For the U.S. government, that's still manageable. We spend more than that on interest payments every month. That's why silver offers the Fed maximum strategic impact with minimal capital outlay. They can build a massive reserve, 500 million ounces, for what amounts to a rounding error inside the federal budget. And once that reserve exists, it becomes leverage. It can be lent to allies. It can be withheld from adversaries. It can be used to stabilize domestic supply chains in a crisis. Silver is strategic in a way gold simply isn't. That's why the Fed chose silver. Now here's what you need to grasp about what happens after the Fed finishes accumulation. After they reach 500 million ounces after Operation Silver Shield is complete, some people assume the price will collapse. They think the Fed was the buyer. The Fed stops buying, demand disappears, and prices fall. They're wrong. The price doesn't drop. The price remains elevated because the underlying fundamentals don't change. Industrial demand continues to surge. Solar panel production is still expanding at about 25% per year. Electric vehicles continue to require more silver per unit. Electronics keep consuming silver in massive quantities. And now with the Fed holding 500 million ounces off the market, locked away inside strategic reserves, the available supply for everyone else shrinks. Miners produce around 850 million ounces per year. Industrial demand is roughly 1 billion ounces per year. That's already a 150 million ounce deficit. And if the Fed isn't selling, if those 500 million ounces are effectively removed from circulation, the deficit doesn't go away. Prices must stay high to destroy enough demand to balance the market. So 267 is not the peak. 267 becomes the floor, the new baseline, the level the market settles around once the Fed is done buying. And from there, silver can move higher. If another shock hits, if China tightens the export restrictions, if mine output underperforms, if retail demand stays elevated, we could easily see 300, 350, 400. 267 would simply be the first major repricing the moment the world recognizes silver as a strategic asset and realizes governments are hoarding it. The next repricing comes later, when the supply deficit becomes undeniable and prices have to climb further to force equilibrium, but that's down the road. For now, focus on 267. That's the target. That's the Fed's number. That's the destination. Now let's talk about the paper trap. Because right now you can get silver exposure through futures around 85. You can buy SLV at a price that tracks spot. And some of you are thinking, why pay 95 or 100 for physical when paper tracks 85? Because paper won't save you. Let me explain what happens to SLV when the Fed starts buying aggressively. SLV holds silver in vaults, primarily JP Morgan vaults. When retail investors pile into SLV shares, the fund is supposed to source physical silver and add it to those vaults. But what happens when the Fed is vacuuming up every available ounce? What happens when there simply isn't metal left to purchase? SLV can't buy silver that isn't there. So the first thing that happens is creations get halted, no new shares. And when investors try to redeem existing shares for physical, when authorized participants attempt to convert shares into metal, SLV won't be able to deliver. Redemptions get suspended. The paper claim loses its anchor to the underlying metal. NAV breaks away from reality. SLV shares trade at $70. Physical silver trades at $200. And you're trapped holding a piece of paper worth $70 while the metal it's supposed to represent is worth $200. You didn't miscalculate, you got robbed. That's when the paper trap snaps shut and there's no clean way out. Don't let that happen. Don't rely on paper. Don't rely on ETFs. Don't rely on futures. Buy physical bars, coins, government-minted pieces with recognizable hallmarks. Take delivery. Put it in a safe. Maintain direct control. Because when the Fed is buying 500 million ounces, when sovereigns are fighting for supply, when retail is panicking, physical becomes the only thing that matters, and physical will be scarce at any price. The people holding physical will be able to set terms. The people holding paper will be left with promises. Choose wisely. Here is your action plan, your go order. Step 1. Buy physical silver immediately. Don't wait for confirmation. Don't wait for the Bloomberg headline. Don't wait for the price to start running. Buy now this week. Call dealers. Order online. Pay the premiums. Get the metal. Step 2. Diversify what you buy. Don't concentrate into one product. Buy eagles, buy maples, buy bars, buy rounds. Buy what you can get because availability will evaporate quickly. Step 3. Take delivery. Don't store it with a dealer. Don't leave it sitting in someone else's vault. Get it shipped to you. Put it in a home safe. Maintain control. Step 4. Hold. Don't trade it. Don't try to flip for quick gains. This isn't a short-term trade, it's wealth preservation. Hold through volatility. Hold through the run to 267. Hold even after it reaches 267 because the story doesn't end there. Step 5. Ignore the noise. Over the next 12 months, you'll hear claims that silver is overvalued. You'll hear analysts call it a bubble. You'll see articles predicting a crash. Ignore them. They don't have the information you have. They haven't read the Jackson Hole document. They don't know about Operation Silver Shield. You do. Trust what you know. Trust the Fed's own modeling. 267, that's the target. That's where this goes. Don't let fear, doubt, or short-term price swings shake you loose. Step 6. Prepare mentally for what's coming. The next 12 months are going to be a ride. You're going to watch silver move from 80 to 100, then to 150, then to 200, and then to 267. Premiums will blow out. Dealers will run dry. And you'll see mainstream media talking about silver every single day. It's going to be chaotic, emotional, stressful. But if you hold physical, if you position during phase 1, if you bought in January and February before the stampede, you'll be fine. You'll be perfectly placed. And you'll watch your wealth expand as silver gets repriced into true strategic asset status. This isn't financial advice. This is intelligence. This is a war report from the front lines of the currency war. The Federal Reserve, the institution that has steered the monetary system for more than a century, just conceded defeat. They admitted the dollar is fading. They admitted hard assets are necessary. They admitted silver is strategic, and they are accumulating 500 million ounces. Operation Silver Shield is real. The Jackson Hole document is real. 267 is the target. And you've been given the information early. You've been given the edge. So the only question is, what are you going to do with it? Are you going to act? Are you going to buy physical silver right now? Or are you going to stall, hesitate, talk yourself into believing it's too good to be real? Because if you wait, if you hesitate, you miss it. February costs more. March turns into chaos. April becomes too late. The window is open right now, January 2026, week 1 of phase 1, the stealth accumulation phase. Buy now, buy physical, hold it. And watch as the Federal Reserve's own buying program pushes silver to 267 and confirms everything we've been saying for years. The war is over. We won. The Fed just admitted it. Now claim your victory. Go.